We got lots of people, and I'm thrilled. I'm thrilled that I think everybody from the last time that we did this on March 20th has come back. So that's a good sign. No one threw in the towel on me, so I appreciate it. I'm very excited for everybody to be here and excited to spend some time with you guys. Hopefully, the people who attended on March the 20th, you did some homework related to your golden rules, and you've started meeting with more sellers. So hopefully that's working well with you. We had a great bunch of consulting sessions after the webinar on March the 20th, which was great. And I appreciate everyone who ordered the materials. And we had some individual consulting sessions, and I received a lot of consulting emails, and I know that proved helpful and had some nice feedback. So thank you for that. For anybody who's new on these, please make sure, if you haven't already done so, watch the first session. It's on YouTube, and we'll also put the link in the chat. It's very important because this is a building block format, and we talked about the determining the right business for you and creating quality deal flow. And it was really very it's a foundational couple of hours. And so if by any chance you haven't viewed that, please do so. Again, the link will be in the chat. And if you don't have it for any reason, email me at any time. There's just a couple things that I'm going to repeat that were in the first session, but for everybody who's new, want to make you aware of it. And primarily want you to understand why I'm doing this. And one of the things that concerns me, and I've been in this industry for many, many years, is just this proliferation of bad information on the internet and misinformation on the internet, or generic information on the internet that really does not prove to be very helpful for individuals looking to acquire businesses. And so over the last year or two, there's been a barrage of it, and especially as it relates to a lot of these people selling, these nonsense courses and boot camps and what have you for thousands and tens of thousands of dollars, and making these delusional promises of buying businesses and closing deals. And at one in 19 said you can close a deal in 19 hours, in heavy cash flowing businesses for no money down, and all this ridiculous information. And that's really bothersome to me. And I want to set the record straight, because people can go down the wrong road very quickly. The other thing is, and probably the bigger catalyst for all of this, is Search Funder, which I've been on for several months, and I really enjoy the platform. But there's part of it that really is concerning to me, which is, like many of you here who have never bought a business before, you have a lot of members on Search Funder that have never bought a business, really no experience or track record operating a business, and asking questions and posting questions to individuals that are in similar situations who have no experience, no track record, and have never bought a business. And people are answering questions to one another, which I know their heart is in the right place, but you can't believe what they're saying because they have no experience and no track record. And so we were laughing about in the last session, was talking about the blind leading the blind. And unless anybody has a wealth of experience in buying businesses, those are not the people that you want to go to for your answers. And so I started keeping a record of a bunch of posts, and I was answering a bunch, and then realized, like, this is a lot of bad information for people. So that proved to be the catalyst for me to say, hey, we're going to do these webinars every couple of weeks, cover some meaningful subjects, and then we will open it up for some Q&A. And I want people to have good information to help you make good decisions along the way for this whole journey of buying a business, because it's not a difficult process, but it's complex. And so when something's complex, you want to try to reduce it to bite-sized pieces and make it manageable. One thing that this is not an infomercial. I'm sure some of you have been on webinars or whatever, and it's nothing but a camouflage version to sell you $1,000 or $10,000 consulting programs, or $5,000 programs related to the subject matter. This is not it. Yes, my company does sell a course on buying a business, and yes, I'm thrilled to say that we've sold 100,000 plus of these and been incredibly successful for many, many years. But this is not an infomercial. Whatever you decide, we'll show about the product at the end, and if anybody has any questions. But the goal of this is to inform you, and whatever decisions you make related to the materials, please understand this is not a covert sales pitch to sign you up to buy courses or other products. We talked about making sure, what I'm trying to convey to you is, when it comes to buying a business, I've been buying and selling businesses for 34 years. I've purchased 14 companies, including one co-investment, and business sizes ranging from $50,000 to over $200 million. I've been buy side rep, sell side rep. I've been an investor. I spent 4 years from 2017 till 2020 in partnership with Ray Dalio and the Dalio family office. I was hired by Ray to mentor his eldest son, Devin, to teach him how to buy businesses. Ray was our sole investor. Devin and I were partners, and we made a number of investments. And my role as a partner and a mentor for Devin, and Devin and I worked together closely as partners. And he was a cherished friend of mine and a trusted partner. We were close like brothers. And unfortunately, and I've mentioned this before, that Devin was killed in a car accident on December 17th, 2020. And so I like to always pay to honor him whenever I'm on these calls, because I miss him dearly. And the second part of it being is to mention that, I always feel very strongly. I like to believe that I'm pretty humble, but I feel very strongly that if what I know is good enough for A. Daly, it's probably good enough for everybody on this phone call as far as my knowledge base related to buying and selling businesses. So I've been in your exact shoes. I bought a number of companies, but early on I made a ton of mistakes. I understand completely what you were going through emotionally, financially, psychologically. And so I can empathize fully with the journey that you are in or about to embark upon. And so that experience, coupled with the number of acquisitions that I've made and the number of buyers that I've been in touch with over the years, and the research that went into our course, which was full year of research, there's probably not much in the relationship in relation to buying a business that I don't know. And don't get me wrong, there's plenty I don't know. But when it comes to buying businesses, I know my stuff, and I enjoy sharing that information. The data that I'm going to provide is based upon thousands of transactions. As I mentioned, we've sold over 100,000 copies of our material. We have remarkable success stories, and we cultivate a lot of data from buyers to understand how they're doing in the process. And so when I quote any numbers to you, it's really based on the universe in which you're operating right now. I'm not just picking numbers out of the sky. These are quantifiable numbers based upon the actions that people in your exact shoes have been taking. So it's important that you understand some of the industry statistics. And again, from people who were here a couple of weeks ago, it's a little bit repetitive, but I want everybody to understand the universe of buying business. And there's a couple of very important data points. And according to industry statistics, over 90% of the people who begin the search to buy a business never complete a transaction. And I call them the 90 percenters. The number is actually 94%. The average person takes 18 months looking and never buys a business. And then when it comes to data points related to the markets of businesses for sale, 75% of the businesses publicly listed for sale on the various bases never sell. And only 10% of businesses publicly listed for sale are represented by business brokers, and predominantly on those business for sale websites. And so what you have when people go down this road, they typically go down and start searching endless business for sale listings, trying to figure out which, if any, are right for them. It's the complete wrong approach, number one. Number two is they're looking in areas where the majority of businesses won't sell, and those businesses only represent about 10% of the businesses publicly listed for sale. So it's no doubt that those numbers are what they are, and they're awful. And interestingly enough, 50% of the deals in the lower market that go to contract fall apart in due diligence. And so understanding those statistics is really important, because if 90% of the people who begin the process of buying a business don't buy a business, well, you obviously don't want to do what they do. It's like, it reminds me of like the old joke when the guy goes to the doctor and says, "Hey, doc, it hurts when I do this." And the doc says, "Well, don't do that." Right? I mean, it's pretty simple. If everybody going down one path is failing and falling off the cliff, you got to go a different way, and you got to go a better way, and follow a proper roadmap. So my goal is to turn everybody on this phone call into a 10 percenter and have you buy a business within 6 months. Just to give you some interesting statistics on the other side, you know, the 94% number, 82% of the people who follow our material and use our free consulting buy a business within 6 months. And so that is your goal. That is my goal. And there's no reason why you shouldn't be able to complete this journey in 6 months. And if you go back to the first video, we lay out the path to getting there in a good way. Next, let's talk about how you can get the most out of today. Number one, you got to be open-minded. Number two, if you've never done this before, you have to have an I know nothing attitude. And that ties into the first thing with being open-minded. Whatever you want to really be starting at the beginning. So you from this day going forward, you start doing this the right way. There's in the course of a 1 year period in the United States, 15 million people will look to buy a business in the lower market. And so business brokers, sellers, lenders, everybody is besieged with inquiries. The majority of people never complete a transaction, but you need to separate yourself from the crowd. And the only way for you to do that is going to be by being properly prepared, being highly educated, and knowing what to do at each step of the process so you could navigate your way successfully. Brokers and sellers don't care about your education. And I know, for example, on Search Funder, there are some very impressive people, and there's some very impressive pedigree related to business schools that you've gone to, and that's phenomenal. But the reality is that piece of the education really has nothing to do with the knowledge that's required to buy a business. And sellers and brokers don't really care about that education. They have one goal, and that is to deal with prospective buyers who are going to be able to get a deal done. And so important to keep that in mind, and again, to keep an open mind. My strategies are simple, they're blunt, they're proven, and they're based upon a building block formula to get you through this process. And there's 23 steps in the business buying process. And they're built one on the other in a simple, manageable, bite-sized piece format. Ideal in the real world. I breathe oxygen from this planet. I'm a no BS type of guy. I'm not a no money down, buy these great business and boot camps and inner circle and all this stuff about that these self-anointed gurus pitch on the internet. I'm not very slick, and you'll see from our presentation, I'm just a basic blue collar nuts and bolts approach to buying a business, which has worked repeatedly for tens of thousands of people. And so understand that when I look at businesses, I believe in buying rock solid, good businesses that can transition well to a new buyer who is the right buyer for that business. And it's a business that can grow with you as the new owner. I don't believe in buying distressed businesses. I don't believe in trying to buy businesses with unrealistic deal terms. Again, I operate in the real world. I like to see people acquire rock solid, good businesses that will transition well to you as the new owner. So that's the introduction. Today for today's topic, two topics. We're going to go for probably a little over an hour, and then I want to open up for as much Q&A as possible. But we're going to talk about the 10 commandments, and that's this. And the second part is going to be valuations and accounting and multiples and gotcha items that unsuspecting business buyers fall prey to all the time. So with that in mind, as they would say in Boston, let's get the patty started. And just to remind everybody, after this, we will be posting the video of the entire webinar. So you can feel free to take notes if you wish, but everything will be there for you after. So let's talk about the 10 commandments and why these 10. The first thing is these keep buyers from going off the rails. They are what I consider to be the ultimate guardrails for individuals buying businesses as you go through the various steps in this process. They're a vehicle to validate every opportunity, and they evaluate the business and you during the business buying process and as the potential owner. The businesses, I believe, must subscribe to all 10. Some of these may be in place already, but if they're not and they can't be done, I wouldn't buy the business. The 10 Commandments also remove the emotion from the decision-making buying process. Okay. And as you go through this whole journey, you're going to see there's tons of decisions that you're going to have to make. And so going back to these throughout the process keeps you level-headed and again provides you with what I believe to be the ultimate guardrails. And you want to be able to test them repeatedly at every stage as you learn more and more about each business. Okay, let's go into each one of these. If you can go into the next slide, please. So commandment number 1 is pay for the past, consider the present, but you buy the business for the future. And what this breaks down to as follows. When you pay for the past, that's related to the financials. That's the financial component of the business as you're going to be evaluating it using historical financial data, statements, etc. So you pay for the business. The price you pay for the business is based upon the past. You have to, of course, consider the present, which is what's happening with the business right now. Is it up? Is it down? Is it going sideways? Are there problems? So there's consideration given to what am I getting immediately, but you are buying it for the future. In other words, what does the future look like for the business, for you in the business, for the growth of potential of the business, for the overall sector? What are the opportunities? What are the potential headwinds? And so what happens oftentimes is individuals actually flip this commandment and they start to value businesses based on the future. And that is a terrible mistake. First of all, you can't predict the future. If you can, call me up, we go to Las Vegas together. But you can't pay for the future because you don't know what the future holds. You pay for the past. And so understanding of the role of the past, the present, and the future is critically important. That's commandment number 1. Commandment number 2 is buy a good business and make it great. The name of our program is How to Buy a Good Business at a Great Price. I believe in good, rock solid businesses and understand. You think about it this way. I call it the 3 G's on the hill. G as in the letter G. Every business starts out when it's a startup or at the beginning is at the bottom of the hill. And that G stands for garbage. Every startup is just, you're trying to predict what the business is going to be. You have no clue. At the beginning, it's garbage when it starts off. It's a garbage business. At the top of the hill are great businesses. Okay. In the middle are good businesses. That's where you should be thinking about acquiring a business when it's in the good stage. And the reason being is, number 1, of course, you want to be past the garbage in the startup stage. And you know the statistics with startups are abysmal of the number of failures. So when you buy a good business in the middle, it's already gone through all that startup phase. Now, you don't have to have a criteria to have business has to be 15 years old, whatever, but you want it to be past all the heartache and the heartburn that came with the startup. So it's in the middle of the good stage. And the reason why you wanted it good and not great is because you want to have that trajectory. You want to be the new owner that takes it on the path from good to great. Now, every business ultimately at some point in time it gets to a pinnacle and it drops, and sometimes it's a few years. Excuse me. Sometimes it's 25 years or 100, but that's the life cycle of a business from garbage, good, great, then it drops off. So you want to be right in the middle and buy a good business, rock solid, that you can take along the way and make it great. Commandment number 3 is ingredients are nothing without a recipe. And what's important to keep in mind here is you'll look at a lot of businesses and they seem to have a lot of good things in place, or they have a lot of good things and they have a lot of bad things in place and things that are mismanaged and not managed well. So you have to take a look back and say, can I put the recipe in place to bring everything together? Because ingredients are nothing without a recipe. It's like if you ever watch that show Top Chef and they send them to Whole Foods and tell them they got to buy, a carrot, 3 pieces of meat, a potato, and something else completely ridiculous, and peaches. And they look at this, and then and they're able to look at it and say, I can make a recipe out of this. Right. And if you follow a recipe, ingredients on their own, I mean, if you were to put all the ingredients out for a recipe and you don't put them together in the right components, you're just going to have a mess on your hand. But if you follow a recipe, it's like anything else. You'll arrive at a good outcome. And so when you look at a business, you have to look and say, okay, they've got all these ingredients, but can I put together the proper recipe to make sure everything gels together? Commandment number 4 is fall in love with the profit potential, not the product. And understand when you go through this process, you want to stay as logical as possible at every stage of the business buying process, but emotion starts to kick in. And people very often with high levels of interest in certain categories, and might be health related or related to animals or certain hobbies that they may have, they start to focus on the product and falling in love with, oh, this wonderful product. And you start to take your eye off the ball of the profit. Because one thing I can assure you, no matter how much you love the product, if the business cannot make money, you'll learn to hate the product really quickly. It's similar to what happens when people who try to buy businesses and turn hobbies into businesses. And very often it doesn't work, because what happens is you end up spending all the time in your business working and you have no time for your hobby. And they end up falling in love. They're in love with the product and not the profit. And so what I like to do when I look at a business, the product is inconsequential. We'll get a little deeper on that because there is a drop down to that, of course. But I look at every product as being like like a flapper in a toilet bowl. The flapper is that thing like when you pull the chain. I'm aging myself. When you put the thing down, the flapper opens up, the water goes down. So I look at everything like a flapper. It's nothing more exciting than that to me. And so it allows me to keep focusing on the profit and not the product. And it's very important because it's very easy to start falling in love with the product as you go through, but you've got to stay level-headed. Commandment number 5 is do what you do best and you'll manage the rest. I'm not going to regurgitate what we talked about in the first session a couple of weeks ago, but it's critically important. The overarching theme here in the mantra that I've been teaching and preaching for 20-something years and has worked so successfully is whatever it is that you do best has to be the single most important driving factor of any of the revenue and profits of any business you consider purchasing. For everything else, you can hire. So when you're looking at a business, it's critical that whatever it is that you do best matches the driver, the revenue, and the profits of the business, because for everything else, you can automate or hire. For commandment number 6, this is called autopilot, which is putting the business on cruise control. And when you're looking at a business, you can make the determination of either do they have automation in place, or can automation be implemented into the business? Because the only way to grow in almost every case is to start automating as many policies, procedures, and processes as possible. We have actually someone who's hopefully on the call, Ethan. We had a conversation this week about a business that he's looking at. And one of the things was he so astutely was able to identify a piece that can be put on autopilot and will become very effective. One of the things was, it's the timing to do that, because you don't want to make many changes, if any, or none at all, when you first take over till you learn the business. But having the recognition and be able to put on the lens of what can I automate? What can I put on onto cruise control in the business? And there's so much technology and inexpensive technology that you can apply to businesses. So some of these businesses have them in place. Other ones, you need to determine whether or not you can do it. Commandment number 7, no one is bigger than the game and what holds the gold. Now, there's a bunch of examples that I have of this, but you have to understand really what is the gold and the luster in the business. And one of the examples that I've used many times and talk about in great detail in the course is this business that I grew up in Montreal. And in one part of Montreal, there's a place called Walensky's, and they sell a sandwich. They've been around for probably, I'm sure it's 100 plus years now. They sell a sandwich, which is like a roll with onion on top, and there's cold cut slices inside, and they press it down real small, and they wrap it up in a napkin and give it to you. I think the sandwich is completely disgusting personally, but people line up and out the door and have been for years buying this sandwich. It's called a special. And when you walk into this place, nothing has changed in this place in 100 years. You walk in this place, they still make soda the old-fashioned way with the scoop and the syrup and the bubbly water, and stir it up with a big, the guy uses a spoon about this big, stirs it up, and you get a cherry Coke or a Coke or orange or whatever it is. And the sodas that I admit are fantastic, but nothing has changed in this place. And when you walk in there, it's like getting thrown back to 100 years. And again, people line up as long as they're open. I think they're open 6 days a week. It's always jam-packed. I don't even think they have tables, as I recall. But when the old man Mo Walensky died, I had thought about buying this business, and it was in a location right near where my parents grew up, and they used to go to that place as kids and whatever. And I thought it would be absolutely phenomenal to buy this business, and my parents would go absolutely bonkers if I did. I thought it'd be great. And so I was sitting around with a couple of buddies at the time, saying, "Hey, maybe we should buy Walensky's, right?" And we started going through the idea and talking about it and having a good conversation. And one of my buddies, who happens to be a top tier accountant in Canada, he said, "Yeah, it'd be great." He said, "We got to change that place." He said, "We got to put in some new furniture, and the way they don't even give you a plate. And I don't understand what they're scooping or whatever. We might have some bottled drinks and whatever." And it was like, whoa, 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 time out. The whole reason for the success of this business, the gold of this business, is that when people walk into this place, they're being taken back in time, like 100 years. It's a real throwback. That's the gold of the business. If you were to make those changes to the business, I guarantee you'd be out of business in a month. And so understanding what the gold is critical. And as it turns out, the families, I think it's the third generation, we couldn't buy it. I tried as best as I could. I couldn't buy it. The family wouldn't sell it to me. They wanted to keep it in the family. One of these, no matter what, we're keeping it in the family, no matter what you offer us, and which I really respect. And I'm glad that they did that, because the tradition continues. And then another one recently was a transaction that was involved, was in the automotive aftermarket business, and was a very complicated, popular product, but complicated. And people would partial order online, but they would also call up because they needed some. It was a do-it-yourself item, but they needed some instructional help and what have you. And the service level of the techs were tech people were very important to explain to people how to install this product. And the new owners decided that they're going to put this onto all into automated chat. So when people had a question, they would just sell it, like those virtual chats that you do. And the business has started to tank as a result, because the gold in the business, when people bought this product, and it was an expensive product, do-it-yourself item, the gold in this business is that they can call up and get a very high level of service and an installation, instructions and guidance. And so again, commandment number 7, knowing what holds the gold in the business, is critical. Commandment number 8 is, so what do you do for a living? You want to be able to explain the business simply. Obviously, if it's too complicated to explain, it's probably too complicated to operate. But you want to be able to explain the business when someone says to you, "So what type of work do you do?" It's got to be, you want to be concise, enthusiastic, and say it with pride. And so when you have to be super proud of your business and what you do, because you're going to be out selling and promoting and building it every day. So if you can't explain the business or present yourself in business situations, or even in the public at large, with enthusiasm and excitement and pride about the business, if you can't do that, the business is probably not for you. Commandment number 9, what's not perfect yet? Now, there's no such thing as a perfect business. Every business has blemishes. Every business has problems. You going to mitigate those during the business buying process. However, when you look at the business and you're doing your evaluation, you want to be able to look at everything and say, okay, what's not perfect in the business right now, as best that I can understand it? How can I fix it? Can I fix it? How can I fix it? And what are the costs to doing so? And so being able to fix all those potential blemishes. Now, if there's some major problems, of course, that you cannot fix, for example, if there's a high degree of customer concentration, whereby a disproportionate number of a disproportionate percentage of the revenue of the business comes from too few customers, and you can't fix that. Well, it's not perfect now, and chances are you can't fix it, and so you have to walk, and you have to have the discipline to walk. Conversely, is being able to look at some of these things and say, can I make them perfect? Okay. And commandment number 10 is, what's it worth to you? very important not to get so hung up on the deal that you forget why you're buying a business. You're buying a business because you want to change your life. You're buying a business because you want to improve your life. You're buying a business because you want to be able to grow and build something. You're buying a business because you want to be able to work with others and empower others and help others and improve your lifestyle. And you're buying a business because you know for every dollar of value that you add in the business, you add to the business, you're going to get three, four, five times that out when you go to sell the business. But it's the old story of not, seeing the forest for the trees. Sometimes people get so deep into the weeds of the deal that they forget the reason why you're buying a business is because you're buying a business for the benefits that it's going to deliver to you and your family and your professional career over a reasonable period of time. Personally, I'm always prepared when I've got to the end of what I'm willing to pay for a business. I'm always willing to pay a premium over and above that by at least 5%. And I've looked at some of these things where, a $500,000 difference over the time that I order going to own the business is like, $150 a day or something. It's like nothing. So don't get stuck into the weeds. Understand this is a personal decision, what it is worth to you and what you're trying to achieve in your life by buying a business. And okay, there's going to be, there's ups and downs. I mean, it's not all easy operating a business, of course not. But it's the benefits that you're going to have from that business. That's what you're buying. And so don't lose sight of what you want this business to deliver versus getting so, crazy and drawing red lines in the sand and red flags and deal breakers and all these things. And you're not prepared to move up another dollar. Don't get crazy with that stuff. Take a step back and understand, what is it worth to you? And so there you have these 10 commandments. These have the genesis of these has been from thousands of transactions. A lot of these are dear to my heart that I've seen work over and over again in countless transactions, and I've seen the flip side where people, if you don't pay attention to these, you end up oftentimes failing or making very expensive mistakes that sometimes it's hard to recover from. So keep these in mind. You want to keep going back to them as you go through various stages, looking at a particular business, and keep putting the business through this stress test. Okay, now we're going to talk about valuing a business. And this is a pretty deep subject. I'm going to try to do my best. I'm checking my time here to make sure we have lots of time for Q&A. I'm going to try to do in 40 minutes what we devote 49 or 50 pages to in the course about business valuations. But I'm going to present you with some information and show you a tool that you can use to help value businesses. And I'm going to give you some real high-level points that you can put to use immediately. So if there's anybody, and I wanted to have a raise of hands from the last time when we did on the Zoom call, so it was more visible, but this is really geared to anybody. If there's anybody who's not 100% comfortable dissecting financial statements, and I don't know if we have a show of hands, Sia or whatever, but if that's possible, great. But if not, we can get to this. We can get to this after. Okay, here I see the hands are raising. Okay, so if you're not 100% comfortable with dissecting financial statements, the first thing I'm going to tell you is it's math. That's the first thing. So it's binary. And so do not panic about that part equation. I don't want to underestimate how important it is, but there's ways to deal with this in a very effective way. You must get familiar with financial statements, and it's easy. It just takes practice. Okay, we have an accounting lesson in the course that dummies it down, and I promise you in an hour you could learn how to you'll learn how to understand financial statements. When I started buying businesses, I had absolutely no knowledge about financial statements, and one of the best pieces of advice I got was taking an accounting course, and I've spent a lot of time learning about accounting. I now consider myself to be a pretty high level expertise when it comes to financial statements, but I knew nothing about them when I started off in my career. And Michael Eisner, and I apologize, that's my typo. It should be Michael Eisner. When he was the former CEO of Disney through its meteoric growth in the 90s and early 2000s. And when he took over Disney, he readily admits he did not know how to read a financial statement. So there's hope for all of us. They generally follow a standard format. And so there may be some slight differences in some. You might they'll talk about sales, other ones will talk about revenue, but it's generally a standard format where you see the revenues of the company, underneath are the cost of goods sold, then below that is the gross profit, and below all of that are the expenses, and then there's a net income number on the bottom of that. And we'll talk about add backs, how that differs from some of the statements that you'll see. And balance sheets are similar, where you'll have, assets and liabilities and shareholders' equity at the bottom. So it's a standard format by and large. Okay. If anything gets overly complicated, you can always bring in your accountant to look at it. When it comes to professional valuations and whether or not you need one, I do not think so. I don't think professional valuations in most cases operate in the real world. They take into account too many pieces that are not fundamental to what a buyer is trying to achieve, and it's very often when a seller, if they've had a professional valuation done, understand that the value that the certified business appraiser is doing the valuation, they know who they're working for. And the information is just not going to be relevant in most cases to the income stream that you're trying to generate as a result of the business. So I do not believe at all that you need one. There may be cases where you dig deeper into the financials or into due diligence, where you need something more robust from your accountant, but you do not need to go in and get a professional valuation to start off this process at all. And for all the CPAs on today's call, and I know we have a few of them, my perspective is CPA should not be doing small and medium business valuations, certainly not small business valuations. And the reason being is their focus is generally too much on the balance sheet, which are the assets of the business. And of all the people that are on the call today, you're buying a business to generate or replace income. And CPAs typically put way too much attention to what are the assets of the business, and assets of the business are used to drive the revenue. But if you have an asset-heavy business that isn't profitable, or you have a business with no assets that making gobs of money, well, business B that's making gobs of money is worth a lot more than business A, irrespective of the assets they have. And I hope when we have the Q&A session, I welcome any pushback from any of the CPAs that are on the call, and we can have a good back and forth, and we'll talk about their role. But my position is clearly that the valuations should be done primarily with the P&L statement and not the balance sheet. Now let's go on to the 7 things that you need to get straight related to valuing a business. Number 1, what a seller thinks their business is worth rarely has anything to do with the value. We've talked about that before, that sellers come up with their purchase price, they put on their blindfold, and they throw a bunch of darts, and that's not an exaggeration. And the asking price of a business, what does it mean? It means nothing. Okay, that's what the asking price of the business means. It means nothing. Don't pay attention to it. Forget about it. You do your valuation based on your know-how and your tools and resources without paying attention to the asking price. At some point, you may come back to it to find out how the seller thought about it, but the asking price of a business has no bearing on what your valuation of the business is, so completely forget about it. Let's talk about rules of thumb. I think rules of thumb are dumb. No 2 businesses are the same, or they're certainly not the exact same, even within franchises. Sometimes you get problematic in the world of buying and selling businesses, where there's some roll-ups, or there's some parameters that are established related to buying businesses, and that muddies the waters a little bit. But rules of thumb are dumb. Every business is unique, and you have to value it based on the fundamentals of that particular business without interference from other businesses. Yes, sometimes industries get hot. Right now, residential services are hot, and so some valuations are going up, and there's some parameters being established. But by and large, that's the exception. It's not the rule. And so everything that you do related to a valuation standpoint has to be done based upon that particular business. When it comes to price and deal terms, I think most sellers are smoking crack. And the business broker dilemma in all of this, and when I say anything disparaging about business brokers or intermediaries, understand that I do intermediary work, very limited basis these days, but I do intermediary work. So if I'm knocking business brokers or intermediaries, I'm knocking my own trade. So I'm just telling you what the facts of the industry are. Business brokers are taught to go out and get listings. It's like no matter what. So they go and get listings, and if it doesn't matter what the price that's put on, because it's with the understanding that if the business is priced too high, they can lower the price if there's no activity after 30 days. And so they have a dilemma to list or not to list, and most of them list. And so understand that when they come to a presentation, they're accomplices to all of this, with the seller being on crack for the most part, because some of them price the businesses properly, most don't. Your valuation must be defensible. If you come up with a valuation that's miles apart from where the seller is on their valuation, yours has to be defensible. They are generally pulling a number out of their butt, or it's a number that they need to retire on, or it's a number that's all based on emotion, based on the blood, sweat, and beers and tears that they put into the business. And so yours has got to be defensible, and don't worry about insulting them as long as yours is defensible. They will put a number together. When they put an asking price together, they're not worried about insulting buyers. So don't feel that you're insulting them as long as you've put it together a thoughtful, quantifiable, and defensible valuation. There's no problem presenting it to seller. You must get comfortable doing initial reviews and valuations on your own, or you're going to spend a fortune needlessly on bringing in professionals every time to do a valuation. Now, there's a lot of talk that valuations are an art and not a science, and that is true. Valuations are an art, not a science, but we must make as much of it as scientific as possible. The art component is, I have a friend of mine who's a certified business appraiser, very highly recognized individual, and he told me in his class of 40 people, when they did their final exam, they get the case study, and they came up with 40 different valuations. So there's the art part right there. And I've had scenarios where professional business appraisers, when they're called by people to value a business, oftentimes they say, well, who am I representing? Because if it's in a divorce, for example, they want to know if representing the husband or the wife, because it's artistic and it gets skewed accordingly. So don't forget that. As far as the science part, you want to be able to attach weights and valuable values to quantifiable business fundamentals and different periods, and attach multiples that make sense from a return on investment standpoint, and mitigating your risk, and marry all the data together. That's the scientific part. And I'm going to show you in a moment a tool that's going to do that for you, and is very helpful, and you'll learn it very quickly. So the idea is marrying all. Yes, it is. Valuations are an art. It is much or more so than a science. Yes, I fundamentally agree with that, but we want to try to get as scientific as possible. Let's talk about the reality of financials in smaller businesses. You must work with quality financials. It is incumbent on the seller, not the buyer. Sometimes the financials are all over the place. You have to set the rules. You're not a forensic accountant. And so, again, it is incumbent upon the seller to provide quality financial statements. And keep in mind, you may only get a recap or a broker's worksheet. You may only get internal P&Ls and not tax returns. But you have to be able to work with them, at least at the beginning stages, to start to cultivate your valuation. And some brokers are idiots, and they expect you to make an offer without any detailed financials. And so, can you really make one? And when should you? Because you're going to come across this. I could almost guarantee it. So if you find yourself in this situation where you don't have enough financial information, they want you to make an offer, you only want to do it when you want to tie up the business. However, your pushback to the broker should be, hey, look, it should be stern and say, look, I can't put together a valuation now that I know I could stand by because I don't have enough information. I need this, that, and the following to be able to do that. Now, if they won't provide that and they want to play games, well, then just play along if you really want to tie up this business. But be very clear to them that the deal will probably change as you learn more. And critically important is this. If you find yourself in that situation, and many people do, add a contingency that the detailed financials are the first item on the due diligence checklist and are required within 3 days of you putting forth an offer. Reviewing the financials, here's a brief guide. If the numbers don't make sense to you, they're not going to make sense to your accountant. So you want to get them first, take a look at them, because again, if they're all over the place, don't bother bringing in and spending money on your account on your CPA, because no matter how competent, or CA as they call in Canada, I know we have a bunch of people in Canada on the call, because no matter how competent they are, it won't make sense to them as well. And you need 3 years of financials on one spreadsheet with matching line items. Okay. And CPAs, CAs, anybody use QuickBook, any other basic software, they can do this easily. So this way you're able to look line by line by line of what activity happened within each one of those accounts over the last 3 years. And you could look for irregularities, fluctuations, if the margins went up and down, fluctuating expenses, where sellers may be cutting to increase profits. And you see this frequently. They may be bringing down the marketing that they're spending, or the payroll. Someone quits and they say, we're not going to hire them till, let's see how this business sale goes. And so there's ways that they can, not fraudulently, but they can manipulate the financials to make things look a little better, knowing that they're planning on selling the business or in the trenches of selling the business. So you want to look for those irregularities. You also want to look for some jumps in some items, and a lot of stuff that we're seeing right now, especially in some of these larger businesses, insurance costs are going through the roof. And so if they're going up, increasing exponentially, those are things that you have to factor into your valuation methods. There's a number of them. You got asset-based valuations, discounted cash flow methods, fair market value, liquidation value, rules of thumb. We said those are dumb. And income multiple, which is sometimes referred to as cash flow based, which is a bad description because cash flow doesn't equal profit, but they're deemed to be cash flow based. So there's 6 of them that are pretty common. And the last one, the income multiple method, which you talked about earlier, because you're buying an income stream. And for that, however, these other methods that are in place, they're good to walk through those exercises because it gives you some greater parameters of valuations, and you can compare and contrast what some of the valuations look like. But income valuation or multiple method is where we're going to be operating. So now let's talk about what number you're multiplying. There's terms that are all over the place. You got EBIT, you got EBITDA, you got adjusted EBITDA, and then you got owner's benefit, also known as seller's discretionary earnings, seller's cash flow, and what they each mean. So EBIT means operating income. EBITDA equals a managed debt-free business because it's earnings before interest, taxes, depreciation, and amortization, whereas EBIT is operating income. It's how assessing the business based on its operating value without depreciation and amortization. And as a matter of fact, some of the larger businesses, and you take individuals like Warren Buffett, they are going to be looking at EBIT. They're buying managed business, and they want to understand what the operating income is. OB, which is owner benefits, which is what, again, this terminology, when you go to some of the business for sale databases, or you get recaps from sellers or intermediaries, they may talk about owner's benefit or seller's discretionary earnings or seller's cash flow or whatever. I use owner benefits. They're all allegedly supposed to mean the same thing, which is it's an owner operator sells to a new owner operator. And this is the amount that the new owner will have available to pay themselves, to service the debt, and invest in the business. It's an owner operated transaction. Okay. The current owner gets up, walks out of their chair. You as the buyer come in and you take their chair. Now, adjusted EBITDA, because EBITDA is a managed business with no debt, generally, adjusted EBITDA, not EBITDA, adjusted EBITDA generally equals owner's benefit. And if you add back a manager's salary to owner's benefit, well, then you have EBITDA. Okay. And I know this is a little quick. So when you watch this again, if you struggle with the financial part of these transactions, take a look at it. And again, and you're always welcome to contact me, and I'm happy to walk you through it again. We want to talk about, when we talk about owner's benefit at EBITDA, when you're going to come across some people, some of the negative people that you may come across during this business buying process that are, I call the naysayers. And some people are going to tell you, what are you buying a business for? You're really just buying a job. And I think that theory is complete BS, because yes, is it true that you may just be buying a job initially? Yeah, it's possible. However, if you look at it this way, most people hate their job, number one. And if someone were to say to you, look, we're going to give you a job at this place. We're going to pay you the same amount of money, and you have an opportunity of unlimited upside. You're going to love what you do every day. You're going to have a chance to, you know, improve your lifestyle and all these wonderful attributes in this job. And you're going to make the same amount of money. You may start off a little less, but you're ultimately going to have a chance to make a lot more. And that sounds absolutely fantastic to you, but there's a cost with buying that job, and you have to pay for that job. Well, most people will pay for the job because I read a recent study where it said 74% of people are despise their work. And so I don't subscribe to the naysayers who say you're only buying a job, because maybe in some part of it at the lower end of the market, that's what you're doing, but that's what you're doing only at the beginning, because you need to, you're looking to replace or generate an income. Now, lower market intermediaries will present owner benefit or adjusted EBITDA valuations most frequently. If you are looking to acquire and operate a business, then it's owner benefits, not EBITDA. Okay. And it's critical. You need to know what's in the number and have a detailed breakdown. And we talked about it earlier. Sometimes it's referred to owner benefits, sometimes seller's discretionary earnings, adjusted cash flow. I mean, there's tons of different terms that are used, and they're allegedly supposed to mean the same thing. And so when you get the breakdown of whatever those adjusted earnings are and whatever they call them, you have to know what's in the number, a detailed breakdown, because what you think is in the number may not be in the number. Okay, so when you're dealing with sellers or intermediaries, you got to qualify that what's in the number. All right. Loosely, 5 times EBITDA equals approximately 3 times owner benefits. And now one of the things that need to be very careful about is what I call lookout, sucker, is capital expenditures. Intermediaries do a great job. They add back the depreciation, but if it's an asset-heavy business, you have to offset all of that number for what it's going to cost you to replace that equipment over time. It's like my mother, his mother says, who just turned 93 a couple of days ago, God bless her, used to say you have to keep money for a rainy day. And so when it's an asset-heavy business, you need to offset these numbers often by what are your future capital expenditures going to be? And sometimes the business is operating in a facility that's owned by the business owner, and they're not charging themselves the right amount of rent that you're going to have to pay after you take over. So you would adjust the number again downwards. Or there's family members working in the business, some of whom may leave, and they are underpaid for the work that they're doing. And you may have to replace a couple of these people and pay a whole lot more for those positions. So those are some of the adjustments downwards that you've got to keep in mind when you're looking at all this. That's why it's critically important to understand the detail of the number you are getting. Okay, now we are going to talk about the owner benefit formula. And again, it's got various terminologies. It is the pre-tax income off the tax return, plus the owner's salary and perks, plus interest, plus depreciation. And the reason why you add back interest is because you're going to decide as the new owner of the business what interest you are getting, what interest you decide to incur. It's not the seller is going to deliver a business by and large free and clear. So whether they will add back prior interest, and it's whether or not how you decide you want to run the business. Plus depreciation is added back because it's a non-cash expenditure. Plus one-time expenses. For example, company incurred a lawsuit last year. It was the first time it's ever happened to them, and they spent $23,000 on legal fees. Well, it's an add back because it was an extraordinary item and a one-time expense. And then there's other add backs of expenses that a new owner will not incur, and that's the optimal word here, is that you as the new owner won't incur it. And then that number is totaled, and then we take off certain items that we just talked about, for example, capital expenditures and other offsets like market rate rent and employee replacement that we talked about. But that's the formula. Make sure you take a picture of the screen. It's detailed in the course and everything we go into in great detail, but this is the number that you're working with, and this is the owner benefit number. And we'll get into how this becomes some of the other financial numbers in a second. So now let's talk about multiples. Well, you've got to have some return on investment considerations. And I believe that Your return on your investment on the cash you invest in a business should be 25 to 33% on return on your cash invested. And here's why. When you take a look at the spectrum of investments, on the one side, on the one end, you have, well, it's a little above putting it under your mattress, but putting it in a savings account or a certificate of deposit you may get today, a fraction, certainly very, very low single digits um, uh, interest on that. On the far end of the scale, you have taking everything you got and putting it onto number 17 black at the roulette table. And that's where you get 35 to 1 returns. So you've got that wide spread. About here, not halfway point, but about here, you have putting the money in the stock market. Okay. And which has historically, over time, returned 11% without you working. And so you've got 0 to very low return here. You got Las Vegas over here. You got the stock market over here. And so you have to be right about here if you're going to invest the money in a business, which is not a liquid investment and comes with a little bit of element of risk. You can mitigate that, of course, and you're going to be working. So that's how you look at this and say you should be getting 25 to 33% return on your cash invested. Now, the fundamentals of the business influence the multiple. And there are 50 of them. When I say the fundamentals of the business, how long are they in business? The conditions of the books and records, any key employees, any key customers, the level of the competition. Do you compete on price, quality, service? Is the business growing? Is the business declining? Have margins increased? Have the systems antiquated? Are there people in the business that hold key licenses? All these are fundamentals. We're going to go over a bunch of them in a minute, but the fundamentals of the business influence the multiples. And keep in mind, when we talk about multiples, you see it quite now a lot, and you see when there's roll-ups happening in an industry. And we're seeing it now in a lot of residential services, HVAC service, and other service businesses. And it happens. They move from industry to industry. Very often roll-ups crash because people overpay dramatically for them to get in there to create some critical mass. And so you have to be very, very cautious if you're acquiring a business where a roll-up is happening. And we said your residential industries are on fire. You have to look out because very often what happens when it starts to trickle down to the lower market, people are going to overpay and multiples that do not make sense based on the return that you need, based on the fundamentals of the business, and keeping in mind, very difficult when it comes to exit. And multiples are shrinking generally, and that happens as a result of the economy, and multiples got crazy inflated. But also understand that multiples will increase as the owner benefit number increase. Not dramatically, but they will go up. And so if you start a business that has a $500,000 owner benefit number in the exact same industry as a business that's got a $2 million owner benefit number, well, the $2 million business is generally going to have a larger multiple as well. Okay. And the multiples in lower men are all over the place, like 1 to 5 times. And when I say 1 times, that's on the real lower end market, more Main Street USA businesses where, it's a business where all the know-how of the business resides with the owner. When the assets of the business leave every day at 5 o'clock, they're all between the ears of the seller. And there's absolutely no guarantee that the business is going to continue if a new owner comes in place. And think along the lines of real personal service businesses, dentists, doctors, physiotherapists, those type of practices where professional services, so much is tied to the owner. Well, you're looking to say, well, there's no guarantee that any customers will continue. So those really trade at the real low end of the market. And in the lower market where we still talk, because I'm assuming no one here is buying billion-dollar companies, but the lower end of the market, the high side is typically around a 5 times multiple. But that's a big, big, big range and can impact the valuation significantly, of course. And so that's why you've got to count on the fundamentals of the business, the level of the business, the return on the investment. All these things have to weigh in order for it to make sense as financially for an acquisition perspective. So the multiple range is large. Do not count on future multiple expansion when the time comes to sell. When you buy a business, the average business sells every 5 years. I've owned a number of business for a lot longer, but that's the average turnover time. Some people will, some people won't, but that's just to give you an average. And so when you're looking to acquire business, if your idea is to grow, get into the business, get immersed, build it up and sell it, not as a flip, but as, you know, to build it up and sell it over time, don't count on the multiple expanding, because it very often will not. Meaning, if you bought a business at 3 times multiple, don't count on it going up to 4 or 5 unless you dramatically increase the profit level. However, even with that said, count on the same multiple, but work on multiplying a bigger number. Meaning, if the business was making $500,000 a year and you're buying it for, let's say, a 3 times multiple, $1.5 million, okay, you look at it and think, well, when the time comes to sell, chances are I'm going to sell this for still a 3 times multiple, but you want to build up the bottom line. And even if you're multiplying it by the same number, even if you're using the same multiple, you're going to be multiplying a bigger number. And taking straight averages over a period of time is useless unless all periods are close. So you'll see that very often in the lower level where sellers or intermediaries will take the last few years, they'll just average them out and they'll attach a multiple. But it may be a case where 3 years ago, the business made $800,000 a year profit, and now it's only making 600, and they're trying to average out those numbers. And you don't want to do that unless the last 3 years are almost spot on consistent, because you have to weigh into the fact of what happening to the business currently. Remember, we pay for the past and we consider the present. Okay, but we have to adjust. So having weights to certain years is critically important as well. I'm going to show you how to do that in a moment. Let's go on to return on investment. I'm going to cover this one quickly. But when we talked about this 20 to 33% return on investment, I used a very low, simple number. If an owner benefit was $300,000 and you bought it for $900,000, the left side of this grid shows you with 90% SBA financing. Some of the cases are pretty popular right now. And so if you were going to leverage the deal with SBA financing and versus buying the business with 50% down, of your own equity and a 50% seller note, and you walk through these numbers, you could see that the buyer's down payment will vary greatly. But as you go down to your ROI, you're taking in your debt service. So just above, I apologize, but if you go down to under percent, like using 90% SBA financing, you put down 100 grand. The lender, I think I've got my mouse here. Hopefully you can see it. The lender is putting up 800,000. The debt service works out to about 128,000. By the way, as a barometer, just based on around today's SBA rates of around 11%, I think there might be 11 and a quarter. You got to calculate about $160,000 per year to service every $1 million. But your owner benefit number below that, you take the 300,000, you take off the debt service of 128,000. You have net on invest of 172,000 on a $100,000 investment. Pretty damn good. Now you're going to say to yourself, but I got to work, right? Of course. So let's go back to this idea of putting a manager into place for this, because most people, you know, and certainly CPAs, and rightly so, will say, well, you got to calculate it based on having a manager in place. That was that EBITDA number. Let's say you go and hire a manager and you pay them $100,000, and net after the manager, you'd still be making $72,000 on $100,000 invested. Pretty damn good investment. You go to the right side, and we're talking about a 50-50 equity. You're putting up 450,000 and the seller's financing 450,000. Now, I'm not suggesting you do this. I just want to give you some, you know, some extremities as far as examples are concerned. And then you get a seller note for 7 years at 6%. Well, your debt service is going to be $79,200 a year. So if you go down to the ROI, you have the same $300,000 owner benefit. You take off the debt service of $79,200. You have a net on invested money of $220,000 on $450,000. But let's talk about the equation. If you hire a manager, same manager agrees to take the job for $100,000, and the net after the manager becomes $120,000 on $450,000 invested, you have a 26.6% return on your investment. Now, this is an extreme case because it's talking about putting down a big whack of cash, okay, and hiring a manager on a business that's making $300,000. You hire a $100,000 manager, which may be high, but you still see, even in this case, we're being as uber conservative as possible, you're still getting a 26.66% return on your cash invested. And every dollar that you add in value in time is going to bring back 3 to 5 times when it comes to sell the business. So now let's talk about add backs. There's two ways to talk about add backs. I like to say this is the time when sellers make me look like George Clooney, or it's like the lipstick on a pig syndrome, right? And I'm sure you've heard that saying. You got to be very careful in some of these because oftentimes the business is made to really look much better than it is. So you need to know what the heck you're doing. So these are the guiding principle. The first one is so obvious, but I see it time and time again, is you can't add back what wasn't expensed, obviously. Number two, often a very sticky point between the parties. Seller presents all these add backs, buyer says you're nuts. And it gets very contentious and it breaks trust real fast. And so you've got to be mindful of this because very often deals go off the rails here quickly because trust is broken because you get the sense they're trying to take advantage of me. And when you start to feel that, like it's very hard to get the deals back on track. Only add back expenses that you will not incur, assuming the status quo in the business. The add backs must be provable. In the very low end, you have some unreported income. I don't believe in it. I know it's illegal. I don't want to look over my shoulder with the IRS coming after my business. I've never run a business that way. But when it comes to run unreported income, no matter what the sellers, if they can't prove it, you cannot pay for it. End of story, because make sure you can't finance it. So you might as well not pay attention to it. And the seller's going to say, well, you're going to say to seller, where you claim that there's all this extra money coming to the business and in cash sales. So I'll tell you what, we'll put that aside. And at the end of a year, I'm going to, I'll add that to the valuation of the business as long as that comes into place. And the seller will say, well, how do I know that you're reporting the right number to me? And you're going to say, exactly. I don't know if you're reporting the right number to me, so I can't pay for it. And I hope everybody is very clear. There's less unreported income in businesses today than it used to be years ago, but they still exist. And it serves you no good whatsoever to pay any attention to it whatsoever because you don't know what you're getting. So now let's talk about some of the broker gotcha items. We talked about capital expenditures. If it's an asset-heavy business and you have to replace equipment after you take over or shortly thereafter, you have to reduce that owner benefit number by the cost of replacing that equipment over time, and we'll get into that in detail. Market rate rent or rent increases, family members we talked about that are above or below market, or the seller tells you, oh yeah, my son works, he does a little bit of the marketing. We only, we don't pay him a whole lot of money. And, then you find out that, he's going to be leaving and that role is not the $60,000 that he's been paying him, but it's a $120,000 role to bring in a proper marketing position. Or they may be overpaid. And so understanding the dynamic of the family members and their compensation. Or broker items, endless add backs, cell phones and vehicles. And they say, start putting vehicles. Well, you're adding back your vehicle, Mr. or Mrs. Seller. Yeah. Do you use your vehicle to deliver any product, go on appointments, do any of that? Yes, of course we do. Well, it's not an add back because it's used in the business. Do you use your cell phone in the business? Yeah, it's not an add back because it's used in the business. And you as a new owner, remember, the third bullet point, you only add back expenses that you will not incur, assuming status quo. You assume that the business is going to continue the same way after you take it over. And so if you are going to incur any of those expenses, they're not add backs. Travel, meals, and entertainment are one-time expenses that are not one-time. Talked about earlier lawsuit. I had one recently where they were adding back legal fees. And the legal fees added back this year were, like for the most recent period, I think it was like $43,000, and said to the other party, hey, wait a minute, these are not one-time expenses. Well, of course they are. I said, but you've had legal expenses that you called extraordinary in each one of the last 4 years. Yeah, the numbers varied, but every year you had a lawsuit. And so it's not a one-time event. A lawsuit is repetitive. And so the numbers may vary, but that is not an add back because that's a cost of you doing business. For whatever reason, it appears that every year you have a lawsuit and they get settled quickly and there's nothing that's going to harm the business or whatever the case may be. But I'm not adding that back because it's not a one-time expense. It's a one-time expense means it happens one time. It doesn't mean it happens every single year. Then it's a four-time expense. So that was not an add back. Seller gotcha items, for example, they may cut expenses knowing the business is going to be for sale. I've seen them cram in sales where they'll go to a distributor will go to one of their customers and gets towards the last quarter of the year, and they ask them to order extra material, put in larger orders. They'll give them extra payment terms, but put in an extra big order that they normally put into the first quarter of the following year so that they can pretty up the numbers for year end. I'm not saying every seller does this because they don't. Not everyone cooks the books because they don't, but they're gotcha items, and you've got to be aware of them because they can happen. They hold off hiring people. They may delay purchases of new systems and equipment, or not replacing personnel, we talked about earlier. So these are all things that you need to pay attention to. And we talked about the case for having to add back a manager. In lower businesses, you're buying a business to replace or generate an income. It's an owner-operated scenario, and that's why you will see in a lot of these breakdowns of financials that there is no add back for a manager. However, you may want to look at from an investment perspective and say, how does this compare and contrast to other investment opportunities that I have? And so you add back in a manager just to do the exercise to see where that comes out. But understand that philosophically, when you look at these, it's going to be an owner benefit, or that adjusted EBITDA number, which is the same, or should be the same rather. And it's an owner-operated business. So you can't, if you're way off into valuation, the seller's saying, no, these are all my add backs, and you're saying, well, it's this minus the cost of seller of a manager, you are actually not correct. That's not the way owner-operator businesses are presented and valued. You can do the exercise. You may not agree with it, but understand that's not how valuations are done in the lower market. It's based on owner-operated businesses. Okay, let's talk about earnouts and performance-based deals, and you need to be aware of this, because if the business has any inconsistencies or any concerns, you have to know how to negotiate performance-based deals. And this is the type of stuff, and we'll cover in a couple slides this, you can put this to use immediately. So when do you do an earnout? When there's been one or good or great or poor year, if there's customer concentration, if there's issues that can impact the future, if there's things that happen in the recent past that may only happen in the future, if there's roller coaster financials or any unknowns, you put in a component of the deal that's performance-based. And here is an example of how to construct an earnout where there may be a customer concentration issue. And customer concentration, we said, is there's a disproportionate amount of business generated by too few customers. You do your financials, and you construct your financials to come up with the owner benefit with the customer. So let's say it's $300,000 and you're going to pay a 3 times multiple, and you come to an enterprise value of $900,000. Then you have to go back and do the exact same exercise without that customer. And you determine that, hey, if I lose that customer, this business only has a $200,000 multiple, and I'm going to make it the benefit of doubt, and I'm going to say I'm still willing to pay a 3 times multiple, but this business is only worth 600,000, not 900, without that customer. And this works the same if you're doing a business that's got 3 million of EBITDA or 10 million of EBITDA. It's just for example. So your purchase price would be $600,000. With the opportunity for the seller to earn the additional 300,000 to take them to 900,000 if the key customer stays at the same level over the next 12 to 24 months. Conceptually, that's how an earnout is structured. Now, let's go into some of the earnout considerations. So sellers, and again, keep in mind, we're doing this example based on customer concentration. It could be a whole lot of other issues, but the earnout portion is the delta between what happens if the business remains status quo versus what happens if an event happens that caused the business to decline or increase. That delta is what the seller can potentially earn. Sellers want the shortest measurement period possible. And of course they do, because they're selling the business, they're going to leave, and they don't know what's going to happen. And they know that currently the business is worth the 900, if you will, but what happens in the future, they're not sure. So they want the shortest measurement period possible, but buyers want the longest, because you want to mitigate your downside as much as you can. So you got a little bit of a conflict here. And sellers are, of course, concerned that buyers can screw up the business, and it's a valid concern. Well, I'm delivering your business for $900,000. Well, what if you piss off the customer or do a terrible job and they decide to stop buying from you? Why is that my problem? Well, they have a legitimate concern there. So here's how you solve for it. You may need a mechanism for the sellers to monitor, and may necessitate having them staying on, even cosmetically, to monitor the account. They may have to stay on board in some capacity to be able to help that transition, to make sure that the provision that you have in place for whatever that earnout piece is gets taken care of. You want to keep the formula simple and agreed to in advance with specific examples, meaning we talked about earlier, if the business does X, I'm going to pay you Y. That's it. And that's the formula. Keep it simple. Now, sometimes you do a variation of that where they say, well, if the business goes up to 300,000, I'll pay you to 9, but let's say it goes to 2, it drops to 250, you pay them a portion thereof. So it's not necessarily binary. There's a formula or some parameters, but you want to have a formula in place, and you want to have a mechanism for it to be audited, and agree to a third party, independent third party in advance. Usually a CPA is the perfect person to have, and name them in advance, because you don't want to get to the end and then there's a disagreement and now you're fighting about the formula and you can't even agree to who's going to be the arbitrator, if you will. So agree to all of this in advance, keep it simple, and agree to all of it in advance. And sometimes it takes a premium to convince the seller and giving them the opportunity that they can earn even more. You get in that same scenario with the $600,000 and $900,000, and I've had it where it was that important to me that there was no way I was going to pay $900,000 for that business without knowing what's happening to, or going to happen potentially, with that customer concentration issue. And I bumped it up. I said, okay, well, instead of 900, I'll pay you 950. If that comes in place, and as long as that happens. And one of the greatest hacks that I find in this whole process of buying businesses, and we're talking about valuation, we're still going to dig a little deeper still, is I'll pay your price, you take my terms. That's a very good way for you to attack it. Now let's go to the item here for massive post-sale items you must consider pre-sale. These are items that surface after a sale. Very often buyers overlook them and they come back to bite them in the rear end, and they become very expensive. Gift card and loyalty programs. In theory, and I believe it's in Canada as well, I know in the US here, that every gift cards do not have an expiration. So in theory, you've sold $1 million worth of gift cards, you sell the business, and then after you close in the business, over the course of whatever times, people can come back and redeem $1 million worth of gift cards, and the new owner is responsible for that. Well, that ain't fair, right? So as a buyer, you want to make sure that you understand what the exposure is and what is the average redemption rate, and you have to keep that money in escrow for X period of time. So if you're looking to say, well, it's been an average redemption rate of 16%, and then after 16% a year, and then after someone has held a card for 4 years, it goes down to zero. What you have to work through all those numbers to determine what it is, and the potential hit that you can take after you take over the business. And whatever that number is, you got to keep it on an escrow for a period of time, usually a year, sometimes a little longer, to make sure that any redemptions on those loyalty cards comes out of the escrow money. It's because it's not the seller got the benefit of it. You can't pay the price for people redeeming it. Inventory, making sure it's good and resellable, and making sure it's based on sales history. It should be an optimal level to run the business status quo. This is especially important when items become obsolete. Even though optimal levels of inventory will be included in the purchase price, it's still factored into the purchase price. So you want to make sure it's good and resellable. So you need to go through the sales history of the various items to make sure they're going to be good and resellable. And unless it's something that has a shelf life and expiration, that's easy to deal with. But if it's something that can go bad, then other than that, in a very general item, I used to use a year as what I deem to be good and resellable. If there's any customer year-end rebates or advertising allowances or markdown money, sometimes depending on the nature of the business at the year end, if customers buy a certain amount for you, they may get a volume rebate. So whatever those allowances or year-end allowances are, you need to factor those in based on history, either have the money in escrow or deducted from the purchase price, because the seller got all the benefit of it and you can't be writing the check for these things because It's not a case of you incurring the cost and they got the benefit. Future customer credits and refunds. And I'll give you a couple of examples. An extreme example. We sell our course with a lifetime money back guarantee. At any point in time, people can return it. We give them all their money back. If you were buying our business, you would look and say, wait a minute, the exposure that I have is unbelievable. We sold millions of dollars worth of this product, and I'm going to have to give people their money back. Well, in our case, we sold over 100,000. I think we got 64 returns, so that doesn't amount to much. So it's not like you're going to hold what would be like $1,280 in escrow. It's meaningless. But you'd look at that and say, hey, theoretically, everybody can come back and want a refund. So you'd have to negotiate. We'd have to come up with a number that makes sense. And I don't know, maybe $100,000 or $200,000 that we would hold in escrow in case there's any returns. Also see it recently where there was a company that was an appliance business. And they did a lot of after sales and service. Appliance companies typically give a 5-year or a manufacturer 5-year parts, 1-year labor. Well, this appliance chain gave the manufacturer's warranty, plus they added a year of free labor. And that was one of their big selling points. Well, if you buy that business, theoretically, anybody who's bought from them in the prior year, you may have to incur the cost to provide free labor. And so you need to come up with how much has that cost in a typical year. Let's say it's 100,000, 50,000, whatever the number of wages related to that extra warranty. And again, you'd keep it in escrow and you'd measure it at the end of the year. Product warranties, which we just talked about. You incur the cost, but the seller got the revenue. Work in progress, where they sell the business and manufacturing stuff is partially finished, and the seller wants to get paid for all of that, but it's not completed goods. So that's one thing to give high consideration to, and very often you end up sharing the profit on that with the seller. End of equipment leases. Do you get the equipment free? Do you have to buy the equipment? The leases expire. You're getting the businesses free and clear. There's no more payments on that. But does that mean that you get the leases? You get the equipment? Sometimes you lease equipment for X number of years, and then you got to give it back. Are there any employment bonuses, benefits, future plans that need to be funded? Here, family compensation and exaggeration about the lack of involvement, which we talked about earlier. You've had cases, I've seen it time and time again. Someone who buys the business, to a couple of months, one of the employees goes to it and says, hey, the owner promised me a $110,000 bonus. Now what do you do? Well, the first thing you do is say, well, let's call the owner and see if that's true, right? Obviously, before the closing, the seller has to make representations of anything material to the business that they've disclosed everything. And of course, they potentially are on the hook for this if it's legitimate. But you may find some employees that it's like blackmail. And so two tax that you're going to take is number one, well, let's call the owner right now and see if that's the case. And the second thing is, say it's not my problem. Now, you don't want to, I've had someone say to me, well, you don't want to say that to an employee because it's not my problem, because then the employee is going to be pissed at you or whatever the case may be. But on the other hand, if an employee comes to you and tells you that and it's not true, do you really want them working for you? So again, these are some of the items post-sale that you must consider pre-sale. Let's go into the DIOMO business valuation spreadsheet. This is what we call the DIOMO business assessment valuation methodology. And we've worked on this for decades to get this. It's a phenomenal tool. And what you do here, this is the idea that we're going to marry all of the components, the fundamentals of the business, which we've put together based on thousands of transactions. And here are the 50 fundamentals related to a business that are critical to the valuation, how long they've been in business, the product and service. Is it highly competitive? Is there an element of exclusivity? Does it compete on quality, price, or service? What is the condition of the inventory? What percentage is good and resaleable? With the employees, any key employees that must stay? Is there a manager in place? Any special or license skills required? If there is licenses, how easy and difficult is it? Is there any customer concentration? Can the is the owner relationship with any of the customers critical? Same thing related to the supplier, any specific relationships. Do any particular suppliers represent a disproportionate amount of volume? The competition, is it highly competitive? Can they easily buy from the competition? Then we talk about the premises, and on it goes. And the condition of the financials, if they're up, they're down, are margins increasing, decreasing? In the past 18 months, has the company decreased any spending that becomes glaringly obvious? Are the systems antiquated, easily replaceable? How expensive? The conditions of the the asset, what the sales terms are like, can it be financeable, financed? And so there's 50 fundamentals in here that are checked off, and there's a weight attached to each of them. First, however, you go in and you add in the financials for last year, 2 years, and 3 years ago, and if you wish, the current year. And there's a whole formula over here where you can annualize numbers. And we say annualize means the current period is not a full year. So you can take the current period and project it out. But you've got to be super careful because number one, you can't predict the future. Number two, annualized numbers are not valid. They give you an idea. And so be very, very cautious before you start using annualized numbers into your financials. I generally will not do them unless there's 9 months of the year passed, that we've already 9 months into the year. Other than that, I just don't pay attention to them. I may use trailing 12 months, but I try not to annualize numbers at all. But in this case, the annualized function, it gives you great functionality because you take the current year's revenue and what percentage of the year does this period represent. So in the past, let's say we're looking at January to June, or January to September. Say, well, in the past, January, September has always been 2/3 of the year's total revenue. So you'd put 66% in here, and then it'll calculate the annualized numbers. But I don't want you to pay attention to that for right now. You put in all of the financials, you put in all of the expenses that the seller provides. Then you come up with the total operating expenses. It gives you the pre-tax profit or loss. If there was any income taxes, they would go in here. You put in the net income or loss here, and then all the add backs, right? That we talked about, which are critical. And then you remove all the adjustments, capital expenditures, etc. And you come up with a total benefit, owner's benefit number for we're going to talk about the last 3 years. Over here. Here it happens to be annualized as well. And then the beauty of this, you can attach weights to each one of these numbers. So we're say, for example, that we're going to use 0 for annualize. And last year, well, you saw it was a huge jump, 4.2 million. And then went from 2.8. You say, well, I'm going to use, some people just, I'm going to use 60% last year, 30% for the year before, 30% for the year before, and 10% for this year. And you click onto the other page and it gives you a valuation based on all these fundamentals that you answered, plus the financials, and they get different weights and values to the importance of the question, and it gives you a valuation. This business, $7,034,000. But then you say, wait a minute, last year was exceptional. It's not going to happen again, and maybe lends itself for an earnout. So remember that 7,034,000. You say, you know what? I'm going to forget about last year for a second, and I'm going to put 50% into the 2 prior years because they were pretty consistent. And now you see, well, the business is worth 4.8 million without that crazy 1 year. So your delta in that case would actually be the earnout. Or you may say, you know what? The business is growing based on the current year. I see the annualized number. It's pretty close. And so I'm going to give this a valuation of last year, 30%. This year, the year before 20, and then 30. And then I'm going to add another 20% based on the annualized numbers. And that takes everything into account because based on where they are currently, I see they're pretty close to last year's number. So last year may not be exceptional. And this is a pretty good weight. And now I say, you know what? Here's the number. Here's the value of the business. So you could see these various scenarios, right? One's if you give heavy weight to an exceptional year. One's if you give no weight and you want to do an earnout. And in the middle is where you say this is a realistic picture. So it gives you the opportunity to play around with all of these things. And that's we've worked on this. We actually did this. It was stress tested with I think it was 1,004, 1,021. For some reason, I always get confused with two numbers. I think it was 1,004 deals to stress test this program, and it's worked unbelievable. It's like become a real gold standard in the industry, which we included our materials, of course, and so that gives you an idea of how that works. And then we want to go to Q&A in a second. I will give you, see if you could bring up the slide related to the materials. I'm going to give you the unapologetic sales pitch for the material that we have. And a lot of you have purchased this already, and which we greatly appreciated. And if anybody wants to comment on how they found it, we've got a lot of consulting clients. We provide free consulting to anyone who buys the materials. I told you it's not an infomercial for what we do. The three most important things to realize with the material, it covers the whole process. You get unlimited personal consulting with me. So during the process, you can email me anytime. We jump on calls. I don't know if Ethan and Josh and Jan, I think, and Jacob were on calls this week that we had set up, and emails going back and forth. So if there's anything I can help you with, I'm always available. We never charge for it. We give you a money back, lifetime money back guarantee. If you're not thrilled with it, we give you your money back. It's got case studies, the valuation template, valuation spreadsheet we just showed him, case studies, legal agreements. There's a whole study guide. You got a 200-point due diligence checklist, the legal clauses, legal forms, letter of intent, solicitation letters, and strategies. It really is an unbelievable program. And if you happen to decide that you want to purchase and you go to richardparker.com/course or just Richard Parker, you do not need to buy the due diligence program plus this. It includes the 200-point due diligence checklist. So I hope everybody is serious about buying a business. I know you are because you attended this. I think it's well worth it. We sell the whole program for $197, including the material, because I'm not doing this to get rich. I just love helping people. And I think you'll find it a godsend to help you. So now we can go. That's my unapologetic sales pitch for the material. I hope everybody enjoying will take advantage of that, and we'll have some great consultation calls together. And let's just get into some Q&A. Okay. We have raised hands. So Sia, can you moderate this, or I don't know how you want to do this?
Yeah, let's go ahead. And there's some questions here. The first one was earlier, and it's from Nate Parker, or I'm sorry, Parkett. If someone
Parquet. I know it's Parquet because I saw him on the list and I first thought it was Parker also. Okay. Hi, Nate. Yes.
I need to learn how to read. Okay, if someone has to run a business remotely, what are a few options beyond software as a service, e-com, agencies?
That's a great question, and it's becoming more popular. The first thing I will tell you that if you have to run a business remotely, you also want to make sure that you're in a position, if necessary, if there are any employees, you have to be in a position that you can attend to the business if something happens. So that's really important, because then that's being realistic about everything. Secondly, is you want to make sure you learn the business yourself at the beginning, and thus you have to immerse yourself pretty much at the beginning to learn that business. But anything that I look at any businesses where there is a second tier of management in place that can operate the business is a business that you could potentially operate remotely. If you are the guy or the gal or the lady or whatever you want to reference, if you're the person that makes the engine run properly, you can't run it remotely. It's got to have a second tier and management in place, or conversely, it's got to have very, very few employees. So industries that are simple, there's a lot of them. I mean, some of the examples that you gave are terrific. There's even other ones that are in distribution. I would not consider manufacturing, because that you need operational know-how, the owner's operational know-how, typically in manufacturing. And so industries that are typically simple, that are more service related in nature, some of the ones that you cited work. There are other ones that could be commercial, large commercial cleaning businesses are popular. Business services are industries that typically you can operate remotely, but again, never take away from the fact that the thing is, there's got to be boots on the ground. There's got to be a very capable manager in place, and it's also got to be the type of business where if something happens to the manager and they disappear tomorrow, you got to be able to jump in and take over the business. And if you have anything further with that, feel free to email me at any time. We can go into a little deeper. Next one.
Excellent. So these are coming in from the Q&A. Those that have typed in a question, if you'd like to verbalize it yourself, we're happy to add you to the panel so you can raise your hand and ask.
Yeah, we can do that. That would be great. Yeah.
So while that's going in progress here, I'll go ahead and do Joseph Evangelista. In the owner's benefit formula, you mentioned pre-tax income off the tax return. If the business files taxes in a cash basis, but the books are in accrual basis, how do you rectify this?
It'll be right in the tax returns where there's a reconciliation of books to records. And so what you want to do is, that's one part of the equation, and it's a great question. What you want to be able to do is take both of the reports and make sure you're operating with the same templates. So you may have to convert one to a cash or one to accrual. But there is tying books to records as part of the tax return. I forget the schedule. Sorry, it slipped my mind for a second. There is a reconciliation where you tie the two together. And there shouldn't be, what you can do is with your CPA, if it's not done in a diligent manner, you can tie it out very quickly. And how you decide to value the business on either formula is going to be sufficient. Because if you were to look into a case and say, if the business ended tomorrow and all the activity caught up, you would still have a number, right? And so it's just a matter of tying the two numbers together. And within the tax return, there is that reconciliation. But if it's that becomes overly complicated, you can operate based on one premise. And it's important to keep that in mind, because especially if a company has big accounts receivable or what have you, you may have to keep that in mind for the working capital that you're going to need on the business. But your valuation you can do on either in one scenario or both scenarios, or with your CPA, can tie the two sets of numbers together so you know what you're working with.
Excellent.
And if you feel free, if there's anything as a drop down, there's a second part to these question that if something I answered isn't clear, please ask a follow-up question.
You got tons of questions here. So follow-up, I think with Joseph here is for earnout conversations. Do you see these happening prior to LOI or in due diligence only?
Both. Great question. Because oftentimes you only become aware of the scenario after you start doing your due diligence and realize, geez, I never thought about this, or, it wasn't disclosed to me. So it could happen either time. Now, if you are aware of it before the LOI, put it into the LOI. The goal of an LOI is to get, you want to go into due diligence and want to have an LOI that's agreed to. You hopefully don't have to modify it, and you want to go into due diligence to be confirmatory, not exploratory. So if there is anything that warrants an earnout, you're just not sure exactly what it may look like, put that into an LOI, because you don't want to start going into that conversation afterwards. And the seller says, well, why didn't you bring this up? So it happens in both cases. And certainly if you see this during the due diligence, of course, it'll raise a red flag and you need to address it. If it's something that you are aware of beforehand and is critical for the deal terms, then you absolutely want to put it into your LOI. But don't worry, very often it does only surface after. It's a great question and point.
Excellent. So we have one from May here, and it's should management drawings bonuses be added back?
Management? No. You're talking if it's non-owner, no, because those typically you're going to have to pay those. You want to keep everybody happy. And so you have to anticipate that you are going to have to pay those if you're keeping the same people on board. Owners bonuses, of course, but not management. If the management is going to stay in place, if you're working for a company and the new owner comes into place, well, you're sure expecting the same bonus, unless, of course, those bonuses were paid based on the owner telling, we're selling the business, so we're going to give you an extra bonus this year. Other than that, those are the bonuses that are paid, and those are what people expect. And if not, you might have a mutiny on your hands if you don't pay them. So I would not add them back. And hi, May, great to see you or hear you.
Well, she says here, with COVID being abnormal years, both ups and downs, do you suggest we remove 2021 and 2022 or use a 5-year average of financials?
I would, unless the COVID year was very stable, what happens is some businesses went way up, some businesses way down. I typically carve them out completely, and the barometer that I've used more often than not is you look at 2019 and say, is that a reasonable reflection on the activity of the business? But the COVID years, and yeah, I mean, if COVID during that period, if it was way up or way down as a result of COVID, you carve them out completely. Then you look at 2022 and you look at 2023, and sometimes you still need an earnout based on the fact that there's been so many inconsistencies over the last couple of years, but it's typically carved out. Completely. No attention paid to it unless it just happened to remain stable during that period. Some industries were way up. Other ones were horrible. But as long as the business came back and you still, and then subsequent to that, you have a couple of extra years. So yes, typically you carve it out completely.
Excellent. Thank you. And Jim Gutt asks, SBA says earnouts are prohibited in the program. Anything I can do to get around that?
I'm not sure if legally, if there's anything that you can do to get around that. I know that we have someone on the call today at SBA Lender. I think Deb Curtis, and I is one of the SBA lenders on the call. You may want to run that by them. You want to make sure that you do everything above board with the in the legalities of the contract. My understanding, and I may be incorrect here, is the earnouts, if they fit within the debt service, I'm not sure if any lenders will still agree or others will be okay with it. I think we're very concerned about earnouts, and I know in the past is when they don't meet the parameters. In other words, if the earnout potentially can impact the debt service. And so I think that's the fundamental most important thing. And the other thing is to, you may have to have a saw off with the seller and an adjustment period post-closing to account for that. But again, you don't want to do anything illegal because then it's mortgage fraud, right? And so sometimes you may have to lower the price of the business if it does not subscribe to the SBA guidelines.
There
Here's
must be
from
some
Deb
settings.
Curtis. No earnouts or distributions can be added per SBA periods, no exceptions. So then your answer is you'd have to lower the purchase price. So I guess a number of years ago, as long as it met the debt service, that's certainly not the case. And so the answer is a clear no, and there's no legal way to get around that. Who was that who answered the original question, by the way?
That was the original question answer was Jim Gutt.
Jim, if you want to send me a direct email, because one of the things that you may have to work towards is the actual purchase price may have to take that into account, and that's where you may have to make that adjustment, which of course will be fine with any SBA lender, and I'm happy to go through with that if you want to send me an email about how you could potentially position that to the seller.
This is again from an anonymous attendee, so sorry we don't have your name. Is this program good for someone who has no business experience?
It's perfect. Of course. I mean, yes, because, for the whole process, the whole process of buying a business is new to most people. So that whole thing has to be learned. As far as it relates to operating a business, one of the biggest concerns that people have is the lack of confidence as to whether or not they can do it. And I'm certainly very, sensitive to that. But what happens is if you go through this process in a methodical way and start to learn how the business or businesses that you look at are operated, you will very often understand that, hey, this is doable for a person like me, or it's not, and it's too complex and I have to consider another business. So I think they're symbiotic. As you go through this process and you gain more knowledge, confidence, and expertise as a result of the materials, you'll start to understand what you should be looking for to determine whether or not it makes sense. Do you have the capabilities to operate a business? And I'm sure you do if you work. It's which type is going to make the most sense. And plus, there's some other options that may make sense to you. So yes, I think it really provides some great clarity to that part of the process, which of course is very important.
Excellent. And I think this was an addendum to it. My question was actually about owner's drawings, not the management team, to clarify.
Owners draw. Well, yeah, there's a whole issue related to that because it's typically a balance sheet item and it's not added back because it'll show up in the pre-tax income on the tax return. So if you put it in twice, if it's on the balance sheet, what's on the balance sheet does not get added back. It's not an expense. So if you added it back, it would be showing twice because it's being taken out of the taxable income.
Ooh, these questions are firing in here. So
Good, keep them coming, baby. I got all afternoon.
I was just gonna say I don't know if everyone else has all afternoon, but let's go with Varun Makashi. He asks, or she asks, sorry, I don't know who you are. They ask, can you elaborate on the difference between EBIT and EBITDA? I always said it wrong.
EBIT is EBIT is the question is the difference between EBIT and EBITDA, correct? Was that the question, Sia?
That's part one.
Yeah. So EBIT is an operating business without depreciation or it's earnings before interest and taxes. That's it. Okay. That gives you the operating income of a business versus EBITDA, which is earnings before interest, taxes, depreciation, and amortization. That takes non-cash expenditures into account and adds those back, whereas EBIT doesn't, because people who look at EBIT say, I'm going to have to incur those expenses. Those are the operating costs of the business. In lower end market of business, you will almost never use EBIT. You will rarely use EBITDA. You will use adjusted EBITDA, which is a normalization of some of the expenses. But EBIT is generally for larger businesses, and it is the income. You're able to look at the operational income of the business operations. It's very important, but it's typically done in larger businesses.
All right. And so their other part of their question is, how should we think about depreciation when evaluating businesses? Isn't that an expense we would incur, or is this covered by including CapEx?
Great question. The answer is more related to part B, which is depreciation is added back because it's a non-cash expense. So that hopefully part makes sense. But yes, indeed, you absolutely gets taken care of when you have a CapEx reduction. And a CapEx reduction, for those who weren't there earlier, whatever, is the reducing the amount of depreciation by what it's going to cost to replace that equipment. So in other words, if depreciation for the year was $50,000 and it gets added back, and you look and you say, hey, over the course of the next 3 years, I've got to spend $75,000 over the next 3 years, $25,000 a year to replace that equipment. Well, on each one of the years that you're using to calculate your owner benefit, you're going to reduce the number by $25,000. So yes, it's a great question because it becomes very confusing, but it only becomes confusing because typically sellers or intermediaries, they add the depreciation, but they don't do the CapEx. So you're very astute in your observation that yes, it should absolutely not be a wash, but one takes the other into account.
Thank you. Okay. Alan Bennett asks, if equipment were at the end of life expectancy, but in good working condition, would you leverage the life expectancy to negotiate the price down?
Well, there's a couple of ways, and also that's a terrific question. You can, because you're supposed to be getting the business in, condition, the business in condition that you can operate a status quo. There's two sides to this equation, though, Al. Number one is, yes, you can use that to leverage down the price of the business. Number one. Number two, but on the flip side, if I'm the seller, I would say to you, well, you're purchasing this business as an asset sale. As an asset sale, you're allowed to step up the value of those assets and depreciate them again. And so while they're fully depreciated on the balance sheet and we're not adding back depreciation, you in fact are able to establish a value of these for I don't know, $500,000 depreciated over the next X number of years. So you're going to get the benefit of depreciation. So if I were the seller, that would be my counter to you. Okay. As a buyer, you could look at it and say, yes, you can absolutely leverage that to a certain extent by saying, hey, I have to replace this equipment in the next few years. And so in this case, I have to take a CapEx allowance off the owner benefit, even though there's no depreciation. So yes, I wanted to put some color onto that for you, but yes, I absolutely would leverage it.
Thank you. All right, Tomas Amodio, how do you know the X for the valuation? 1 to 5X is a wide range based on ROI of invested?
Yes, it's a massive range. I agree with you categorically. Yes, it's huge. And so there are some general parameters. As we talked about earlier, when you start getting away from real Main Street USA businesses, typically businesses are going to sell, 2.5 to 5 times or what have you. The return on investment is critically important. The way we do it, and we've automated all of it, is there are some tiers, if you will. Just to give you an idea, when I say tears, not tears coming from my eyes if I bought the wrong business, but tears as in levels. Um, Businesses, and these are very, very broad parameters, which is businesses with that, that have again, $500,000 of owner benefit at just their own benefit will sell 1 to 3 times, 500,000 to $1 million plus. Will sell 2 to 4, and $1.5 million plus to $4 million of sales. Sell 3 to 5 times. Again, very general parameters. I just want to give you something to think about. But the way we do it with the automated formula is we count in, of course, ROI, but it's the business fundamentals that are critically important. Taking those multiples that act as parameters, assuming you have to achieve a 25 to 33% return on your investment. Okay, that's where we attach the scientific part. But so yes, ROI plays a key role in it. The weights to all the questions play a very key role in it. The level of owner benefit plays a role, not as significantly, but it does. And so all those things working together is what comes up with the multiple. I talked about the 1 to 5 times to give you some parameters and an understanding of how crazy this world of valuations can be if you don't add a component of science to it. Because 1 to 5, it's exactly like you said, it's nuts. I mean, it's so broad. And so we need to add as much science to it as possible.
Awesome. Okay, well, here's another one here. What are your thoughts on royalties or other earnouts to increase overall price to seller? The
I
math part makes sense in balancing versus financing, but more out of principle or challenges.
I think wherever it makes sense to have royalty and performance-based deals, you should put them into place. But some businesses, if they're performing very well, there's no big risks, they're going to sell for a good multiple, and you don't want to undo a deal or lose a deal just because you become neurotic about having performance-based guarantees in there because you're overly neurotic or start getting too crazy related to risk mitigation. With that said, there are plenty of businesses that warrant royalty, performance-based deals, and/or earnout deals. And when those cases arise and they make sense, absolutely, I wouldn't settle for anything less when I say anything less, unless it was stealing the business with the purchase price. And so when those components make sense, you absolutely have to put them into place. Because if not, the goal is to mitigate your risk here.
Okay. So I just sent a note out to Luigi. So, Luigi, would you like to go ahead and verbalize your question because you've been so patient with your hand up?
Yeah.
Let me go
Put them on the
ahead.
panel so we can ask the question.
All right.
And I do have to make a note because I'm not sure if Jacob is on because Jacob had a great point I wanted people to mention. Hi, Luigi.
Hey, Richard. Thanks for answering my question. Great. Yeah, thanks for the session. It's super informative, and your last one was as well. I actually have a question that really pertained more to your last session, if you don't mind. But I definitely understand the value of defining the business that's right for you based on your experiences, skills, and your 5 golden rules, as you called it. But does that risk closing you off to opportunities that you don't know about? So industries you don't know about, business types of businesses you don't know about, things that may happen to come through from a broker or something. And if you're too laser focused on a particular type of business, are you closing yourself off, especially if you don't have a wide sort of breadth of experience?
If you're laser focused on a type of business, that should only happen when you are abundantly clear on the exact type of business that you should purchase. You should be completely open-minded about the type or types of businesses at the beginning until you are crystal clear of what type makes sense for you. That's why you go through the sectors and the different types and then specifics. So you don't want to close yourself off to any industries whatsoever until you know without question, here's the type of business. This is the type of business that's perfect for my skill set. And you have to stress test that with as many different industries as possible. The way you're describing it is sort of backing into it, and you got to go the other way. Okay, wide at the top, as many as possible, and then you get squeeze out at the bottom, here's the type or types of businesses that are right for me. Now, if something surfaces in something else, you at that point, when you know, here's my greatest skill set, here's my 5 golden rules, you can apply that to any industry. So I never rule out. I rather rule in. At the beginning, I want to be wide at the top and then get it narrow as you go down, and never be closed-minded about an industry unless I know for sure that, manufacturing's, or I mean, give you an example, manufacturing business are not for me. And so then it doesn't matter what they manufacture. I just know that I'm not skilled to run a manufacturing business, but I wouldn't care about the industry. I don't personally. The industry makes no difference to me. It shouldn't to you. You'd be industry agnostic. Don't pay attention to your experience. It's all based on the expertise.
Got it. And how long do you recommend doing that sort of laboratory exercise that you outlined, where
4 months or less?
Months.
It should take you 4 months to look at all these types of businesses. You close the deal in 6 months. 4 months to do your laboratory, sometimes less. I mean, if you have time and you're doing this full time, you should be able to see 30 businesses in a month, right? If so, take you less time. But if you stretch this out, the whole search process should last maximum 4 months, a month to negotiate, a month to do your due diligence. Sometimes the last 2 months, could be a month and a half to negotiation, 2 months of due diligence longer. But that 4-month period of narrowing it down to the business, that should be the absolute outside time limit if you're doing this full time.
Got it. Thank you very much.
My pleasure. Nice to put a face to your emails and our posts back and forth, man.
All right. So we have
Jacob Van, I want to make sure I'm pronouncing it properly. He's a client of ours. He bought the course. We had some good emails back and forth. Jacob Van Hoofen, I'm not sure, and I want to make sure I'm pronouncing it properly. I'm not sure if he's still on the call, but he had brought up a great thing related to last week when we were talking about searching. He has found that if you go to your local library and you get a public library card, they have access to a lot of the databases that you would potentially pay for to put together a list to do direct solicitation. So I'm not sure if Jacob is still on the call. I wanted him to let everybody know about that, but I thought it was a phenomenal idea. And that's how some of the material has evolved over the years. We get some great ideas from clients. So again, he has found that, where he goes, he got a public library card. And through that, at the library, was able to access some databases with company SIC codes, I believe, and other information to get to the owner's name, address, etc., and able to send out direct solicitation. So, Jacob, if you're on the call, thank you very much for that suggestion. And if you jumped off earlier, I apologize. I didn't acknowledge you earlier because that was really a helpful recommendation. Okay, we got 4 other questions, I think.
Yeah, we've got quite a bit. So
that's okay. Good.
This is from an anonymous attendee.
Okay, and we covered a part of this in the last session, so I hope you would watch that again. And this is really important to me when I give you this answer, okay? Because I don't want you to fall for any BS programs that tell you you can buy a business with no money, no credit, no nothing. It's not true. And so in situations where people don't have any capital whatsoever, the first thing is they should at least go through the process of meeting with a preferred SBA lender, speak with someone like Deb, who provides some great answers on this call, and find out the parameters by which you may or may not qualify for SBA, because oftentimes you can get in, I shouldn't say oftentimes, there are times in certain conditions where you can get in there, what I think Deb was like 1% down or something with the seller contributes. But I'm not an expert in SBA loans, so you need to find an expert like Deb, and you can find her debcurtis.com. Where she can answer that question. Failing that, you need to get seller financing. Now, the percentage is going to vary, and it is rare that you're going to get 100% seller financing. And I just want to give you a realistic expectation of this universe. And so in some cases, what you may have to do, you may have to buy less of the business, right? And work out terms with the seller. And in situations where people really have, no money, credit history is bad, nothing that they could put onto the business. If there's family and friends that you can tap into, great. Investors that you could potentially approach, that's great. But if none of that exists, okay, zero, none of that exists, the option is really to make sure you understand what type of business is right for you. You find an owner who's considering retiring in the next year, couple of years, or what have you, And then you may want to work out a deal where you get an opportunity to work in the business for a year or two and get some sweat equity to help cover your entry point and down payment on the business. These scenarios do not happen often. And so I don't want to be misleading to people to say you could do this all day long. They are more rare, but they do happen. And if you don't have any options related to the capital, that's your only option. Now, maybe you're somewhere in between, and I'm happy to have a conversation with you separate and apart because some personal questions that I'd want to ask you, and I don't expect you to disclose them here. So please get in touch with me separately. But there are some potential options. You just have to be very realistic about what those are so you can get to the finish line.
Excellent. Thank you. And the follow on that is that individual does not live in the United States. So
That's okay.
SBA's, is it for
Okay.
USA only?
Yep. Yes.
Okay. So recommendation for you is just reach out to Richard. Okay. We've had another
Reach
question
out to
here.
Richard or some of the sellers that you've potentially spoken to, the scenarios of where you can get in and acquire less than 100% of the business, or potentially work there for a year or two and generate some sweat equity. Because if there are some options when you don't have options, except they are limited.
Excellent. Thank you. Okay. So we've got quite a bit on the chat as well, but let's get this last Q&A that I see here is from May. Is it Bergen? My apologies on that. How much credibility do you place on industry reports on multiples? For example, PitchBook, and also some consulting firms publish paid reports on transaction multiples for an industry.
Yeah, I'd give them a little bit of, pay a little bit of value to them, not much, because I just believe rules of thumb are dumb. So it gives some parameters for a phone conversation or a meeting with a seller, but they don't influence my idea related to multiples because it's got to make sense on my return on my investment and capital expenditures, etc. And we had that conversation, May, when we were talking about a recent transaction and what the return looks like and some of the post-investment has to be made. So I look at it and I don't pay a whole lot of attention to it.
So thank you very much. Okay, this is going back up. A lot of great questions here. So from John Baker, how do you typically account for the working capital required to operate the business? How much weight do you place on this when determining your acquisition multiple?
Well, the acquisition multiple does not get factored in by the working capital requirements because it's a balance sheet items and you're using a profit and loss statement to calculate your calculate your valuation. But I know exactly what you're asking, and I'm not trying to change your question. I know exactly what you're asking is when you factor in what this business is going to cost you, how do you weigh in the working capital? And I'm assuming that's really what you're trying to get to here. And if you're not, ask a follow-up question. Valuation is done separately. You look at the working capital. The textbook working capital definition, of course, is current assets minus current liabilities. They're not always applicable because the number may be lower or may be higher, which is on the balance sheet. The lower the transaction size, the less that working capital is included by the seller in the transaction. In other words, on smaller transactions, the seller takes the balance sheet. They take the cash, they take the receivables, they pay off the payables, they leave you the inventory and the equipment to operate the business. And there's no working capital left in the business. The way I look at it and the deal sizes that I look on is I take a look and say, okay, I take the textbook definition of current assets minus current liabilities and see what that number comes into. I generally like to take a few months and get a few months worth of working capital just as a buffer. I assume a decline in the business, a short-term decline in the business, sometimes 10, sometimes 20%, and say the difference between that two and what the fixed expenses are going to be is what I look to the seller to provide as working capital and to leave it in the business. However, I want to mention again, the lower end of the market, business is 2, 3, $4 or $5 million of acquisition. Very often there's no working capital provision. No net working capital provision, meaning that the seller is not leaving net working capital, typically on larger deals.
Awesome. Okay, so thank you on that. So Joe Comer, I'm curious how much your course touches on revenue-based valuations, thinking about this with respect to software businesses.
Okay, so it's a great question, okay? Because there are some cases where revenue-based valuations are done and it happens in the world of SaaS, software as a service. And it's a nutty multiple because if you don't grow the business or it doesn't catch up, you're never going to make any money. But I understand that's how they're set. So our business discusses multiples based on income. But understand, there's 23 steps in the process. So before you even get to the point of determining evaluations, how do you find these business? How do you negotiate this business? What are critical clauses that you need to have? Considerations to be made? What due diligence that you need to do? Need to do? How you close the deal? Legal considerations? Where to find these businesses? So there's so many parts of this prospect to this project of buying a business separate and apart from valuations. And of course, the material covers all of that in great depth. When it comes to valuations, you still need to know to make sure that the revenues make sense, okay, that they are, of course, accurate and correct. If you are looking at a SaaS business, well, the reality is the valuation tool that we have in the course, besides the 23 other chapters in the course, doesn't matter that much because you're multiplying revenue, whether I agree with it or not, or whether it becomes an overpayment. I understand that that's the norm in the business. So it doesn't matter. Like, you don't really need any valuation tool, right? Because you're multiplying revenue. But and certainly I've got some good multiples just involved in a transaction with a digitization business, so I can give you some parameters on that as well. But the balance of material, again, I never like to sound like this is an infomercial for selling the course. I mean, you've got a gazillion other things that you have to consider besides the valuation when you're looking at to make sure the business is right. And of course, all those things are covered in great detail.
Thank you. All right. This is from Simar Anand. How
Yes,
do you
Simar.
deal with transaction bonuses, particularly for senior management that may be a flight risk post-closing?
When you say if there's transaction bonuses where they pay, I want to make sure I understand the question. If they were paid something over and above by the seller because as part of their transaction, in other words, very often it happens where the seller says, if I sell this business, I'm going to give you X part of the proceeds of the sale. Yeah. When you're looking at evaluating employees, well, first of all, the thing is, if that's related to the prior owner giving them a bonus because of the proceeds they got for the sale, that's not incumbent on you to have to give that. That's one thing. The second part of this, when you get into flight risk employees, people that have been there for a very long time or may leave, here's how I adjust employees when you look at a business. Anybody who's key to the business, you got to meet with them. If the seller doesn't want, they can stamp their feet and bang their head against the wall. It's got to be the final contingency, because if they're key to the business, you absolutely have to meet with them. I mean, you can't walk into a business cold with no comfort level whatsoever, whether or not these people are going to stay. And so if they're key employees, it may be the last contingency to the deal after everything else is satisfied, but you have to meet with them. On the ones that are older employees and maybe we call it flight risk because of, maybe retiring or whatever, especially if they occupy an important position, you absolutely have to meet with them. And if they're not going to be staying, you not only have to think about the cost to replace those people, but can you replace them altogether with the right people? And you want them to be super conservative about going into business where there's any key employees. If you can't replace them, or if you have to replace them, you got to be very, very cautious about it. If the question was related to arbitrary bonuses that employees get, those have to continue, because employees will become disgruntled pretty quickly if you put them under a new pay structure. So hopefully I addressed both possible scenarios for either of those. If it doesn't, put in the chat and we'll expand upon it a little quicker.
Excellent. I think we're going to go with the last two folks here because you can keep talking forever and we know this. And so thank you very much.
Is that a bad thing?
Everyone says thank you. Everyone's really appreciative of this. So Chris Thompson, he's got a couple. So are asset-based valuations simply the value of their assets stated less the liabilities?
Yeah.
Okay. What else is in the valuation? There is no multiple. Any other intangibles, customer base, brand, name recognition, etc.
All of that. Do you have, when you talk an asset-based valuation, it gives weight to all of the assets and all of the liabilities and goodwill, intangible, etc. And that's why asset-based valuations really don't work.
All right.
They could be considered when you look at the whole picture, but sometimes they're used in distressed businesses, which I don't believe in acquiring, but asset-based valuations, you're buying an income stream. And the way I try to present this to people, you may want to look at the asset-based valuation strictly, when you're considering what their asking price is versus the book value of the business. I get all of that. But the assets of a business, and we talked about it earlier, assets of a business are a vehicle to drive the revenue and profits of a business. And so if you have an asset-rich business that's not making any money compared to a business that has no assets, make a lot of money, the business with no assets is worth a lot more despite the assets, because the reality, even if you talk about asset-based, when they talk about, the value, go try to sell those assets. If you have to sell them in a hurry, they're rarely what the sellers presented them to be worth, or maybe be less than what they're on the books for. So I've almost never seen where asset-based valuations work, unless you're talking about someone buying, something in oil and gas business or pipelines or that type of stuff, where you're buying the assets and you're going to quickly integrate them into your business and convert them into revenues and profits shortly thereafter. But all of the answer to all of your question, to your particular question, was yes, yes, and yes for all the ways that you asked about how you go about doing it.
Thank you. All right. This is from Brinton Boast. What are your views on looking for off-market businesses? Do you prescribe folks to knock on doors, call, mail, just normal businesses?
Yep.
I may have missed this in the start of the call.
I would suggest, number one, you go back and watch the first webinar, because we did cover that completely. But yes, absolutely, categorically, emphatically, yes, you want to you use the publicly listed markets to initially evaluate businesses, to get in tune with what type of business is right for you. Very often the business that makes sense for you to acquire may not be publicly listed, so you have to expand your search dramatically. You get the word out to everybody and everyone. You yell it from the mountaintops that you're looking to buy a business once you know the type of business that you want to buy. And absolutely, you want to do direct solicitations. We covered in the first, we have a letter template for direct solicitations, or solicitations done by a third party for business owners. We've had some, our response rate has been crazy. We've had them like from 2% to 40%. So it's like all over the map. But that solicitation that you do directly, yes, I encourage you absolutely to do that once you know the type of business or types, one or two types that you want to buy. And the other thing that, if you go back and watch the video, we highly recommend, is you want to take that letter and you want to have that letter sent out by your attorney. They're going to use you as the contact person, but you want to have it coming from an attorney, because everybody opens up a lawyer's letter, and the letterhead will be from them and the envelope will be from them, versus business owners are blasted with emails and letters from brokers and other, prospective business buyers every day. I'm interested in buying your business, or I have someone who wants to buy your business. So you have to separate yourself. You sent a letter on your attorney's letterhead, and you'll find some of the response rates have been unbelievable. But yes, Britton, absolutely, you want to do direct solicitations and go way beyond, no question, to go off market. Yes.
Excellent. And this will be the last one. And it does answer 4 other people have asked the exact same question. So I'll just give it to Ray Woods. This webinar has been great. Where can we get the link to the video recording for the session and the previous session?
Okay, so we may be able to put the link to the previous session in the chat. However, Ray and 4 others, a couple things. One, when you registered for this webinar, there was at the bottom, it said, if you'd like to see the first one, here's where you go to. So if you missed that, CEO will put the link in this one, and hopefully you won't miss that. But if you go to my YouTube channel, which is Richard Parker Diomo, Diomo, in videos, you will see it. And maybe I can get a screen share. Sia, you can put if you can put the link in there, that would be great. I'd also love people to, if you could put the link in. Mike Miller, who's is the head of Regenerative Capital Group, along with Cordell Jacks. You've heard from May Bergen today. She's one of the winning CEOs in residence. He's underwriting 5 CEOs every year for the next 10 years. I did a quick 2-minute video with him today. Maybe you can show this, because that was a phenomenal video, and it's on our LinkedIn today. Mike bought our course almost 20 years ago. And he bought, and the course has changed multiple times, of course, been upgraded. Him and his partner, Iggy Domagowski, bought a bunch of businesses, smaller businesses. They built them up, and they ended up to over $200 million in revenue. Here we go.
A good business, but I didn't have a playbook. And I didn't have all the experience about here.
How helpful was the information to you and your partners when you started the journey of buying businesses?
It was, as I call it, the Bible, for good reason. It wasn't about the finding a good business. I knew what a good business looked like. I had 25 years in financial services, and so I knew what a good business, but I didn't have a playbook. And I didn't have all the experience about here will be the emotional roller coaster, and here will be this. And any time as we started down this, you know, you get a little discouraged and you get this, is you just go back and say, oh yeah, Richard wrote about that, oh yeah, you have to do this, right? And so it became, like we call it a Bible, but a blueprint. And a blueprint is very, you do this first, you pour the concrete before you put the lights in, you know, like, and it was very well laid out. And it's been 20 years roughly, right?
2007,
yeah, and so 2006. And so, you know, it's timeless. What you wrote is timeless because people are the same, right? Whether they were born in 1950 or, you know, they have maybe different passion, but the emotions and all that stuff. So what you wrote is a blueprint and it's timeless, and anybody's going to find a business, which is, you and I agree, that's the best way to create wealth. And compounding is the eighth wonder of the world, as Buffett would say, and all this thing. Just be stupid not to buy that book and go through and read it, and because it's timeless. That's all I can say.
Thank you. Check it out if you guys are in Canada or think about potentially moving to Canada. Check out Regenerative Capital Group. They're taking applications for the next group of 5 cohorts, and they invited me to do the educational portion. They brought everybody down to Mexico for a first class education session. And Mike and his partner Iggy are one of my poster boy students, and they're still using. They built their businesses up to over $200 million of revenue. And I'm talking about they bought small businesses over a number of years, and then they ended up selling out for over $100 million. It's a beautiful story. And then the first webinar is on the YouTube channel. You go into the videos and you'll see it. And I think we see it put up there with a big webinar graphic on it. So that's very helpful. And then this one, we should be done. Today's Wednesday. So probably CEO works like at the speed of light. So probably by Thursday at the end of the day, it'll be up as well. And you'll be able to watch that in totality.
I felt that pressure. No worries.
Well, I was going to say today at 5, but I'm going to give you a little bit of leeway. Come on, let's go.
So thank you very much. We're done, my friend.
Oh, wonderful. What time? Oh, 2:21. Okay, good. So everybody, we had a lot of participants, which was great. And I appreciate everybody being on this. Next time, we're going to run one of these again in a couple of weeks. We're going to cover preparing to meet the seller, things that you need to do in advance, what you need to do when you're submitting any inquiries. I think that we'll probably also cover key questions to ask the seller. I'd love you guys to provide some feedback as to what you thought about the session. And I've got skin as thick as a Buick, so the more critical, the better, because we just want to make them, we want to make this better as much as, these sessions really, really good. Please spread the word, because I'd love to open this up to as many people as possible. So if you thought they're good and more people could benefit from it, I'd ask you to, use your own social media and spread the word related to these sessions. That would be really, really helpful. And I think that's it. The video will be posted. There'll be the next one will be up, and I'll do a post on Search Funder and our website. We'll send out emails to everybody. And it's great having everybody around. And I thank you very much for your time. The one thing that I was also thinking about is perhaps in the off weeks to do like an Ask Me Anything, an hour and a half session, let people drop in the way they want, as they have time to do, and just ask any questions they have and do the educational component every couple of weeks. So if you have any thoughts on that, I welcome your feedback, and thank you for your time. I know it's valuable, and I appreciate you putting up with having to listen to me for a couple of hours, and thank you, and good luck with everybody. Good luck with everything to everybody.